Discussions on this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Axiom Wealth Partners are not affiliated.
Hello, everybody. I am Sarah Lyman, your co-host today for Real Estate Tips with SNL.
Yes, it is. And thank you for joining again. I'm so excited that you're here. I'm Lana Sara, Coldwell banker, and I am here to introduce Dave, Jen, Kerry. Welcome. I'm not even going to talk too much about your background because I want you to give me a little bio. And then we'll get into the meat and potatoes, what we're talking about. Well, we're talking about money today, finances. So give me, whoever's going to speak first, give me a little synopsis, your background.
So
Thank you.
I'm Kerry Castigay. I'm a financial advisor with Axiom Wealth Partners. We're working together since last year. Mm-hmm. Jen's been working with me for a couple of years. I've been an advisor for 20 years. Dave has had 18 years of experience, is that right?
Correct.
And Jen, you're 14 in the industry. Yeah. So I hired Jen to work with me to help me with some a merger between our broker-dealers, and she did a great job, and I asked her to stay on permanently, and she did. And then as a result of that merger, I had worked with Dave at Cantella, which is a broker-dealer. He was the operations manager there. And I loved working with him. He was a great guy. Anytime you had a problem, if you called him, he would make sure it got fixed and follow through and keep me posted on how it was going. So I really love working with Dave.
Nice.
Her husband. Yeah. And he became available in the merger because they downsized. And so we scooped him up, and we're happy to have him. Why don't you guys...
Scooped you up.
Yeah.
Like an ice cream.
Yeah. The duo team.
The dynamic duo.
I love that. Yeah. I love that. So today we're going to talk about probably some finances and whatnot, but let's get into some of the concerns or questions. There was a subscriber that reached out and wanted to know a little bit more about the quote capital gains that happens in real estate. So who wants to start, and what is that all about?
I'll take that one, Lana. So for capital gains, that is the difference in which you purchase an instrument, whether it's real estate, a mutual fund, a stock, or a bond. And then the difference of what you sell it for, that difference is potentially taxable. In real estate, you have different options like depreciation that might help offset some of those capital gains, or if you add an extension to the home or add a roof, then those are items that can be included in the cost that can be reducing or help reduce your cost basis. So for capital gains, there's different tax treatment. And I'll say this upfront, we're not tax professionals. There's 6,800 pages in the IRS code. So, and that doesn't include any Treasury guidance or any other federal legislation that was applied. That actually brings it to 75,000 pages. So, so we're interestingly, on the boundaries of, working with clients for tax efficient strategies to help them try and mitigate their tax consequence. And with cost basis and with capital gains, that's something that we're working with every day, and with mutual funds, stocks, and bonds. So for a real estate purchase, if you're looking to sell an investment property or a business property, then you could potentially run into a capital gain situation there if you don't do a 1031 exchange, which is just another way to defer your capital gains. And there's a lot of requirements that need to be met in order to take advantage of a 1031 exchange on an investment property. So you need to have a qualified intermediary institution, and
A really good attorney.
a really good attorney. You got
And a
it.
really great real estate
A
agent.
really great real estate agent,
Yeah.
for sure.
Right.
Sure.
Right.
And some few other items. Yeah.
For most people that are just buying their
Yeah.
residence,
Right.
there's a $250,000 per person
Is it a
Option.
cap?
exclusion.
Yeah.
So the first $250,000 of gains is not taxed, and if you're a couple, then it's $500,000.
Let's take this down. Let's go to like, so when you say 250,000 or 500,000
Yeah.
exclusion, you're saying what they would net from?
Yeah. So if you bought a home for 500,000, and that was your basis when you sold it later for 750, a single person would not owe any tax unless they got more than 750. The first 250,000 of
Got it.
gains is not taxed, and for a couple, it's 500,000.
And that applies to primary residence, not an investment property. So
Okay, so primary residence, they're going to sell it. The first question they always ask is, what do I have to pay for a tax on that? So you said that. Now you also brought in the conversation about, if you did improvements. So it's really important to keep a portfolio, almost like, to know what you've done to it. So basically, they would be adding in, like, we did a roof, we added a garage, we did this, we did that. And then that would come into consideration with the 250 or the 500?
Well, repairs and maintenance, no, but if you added a garage, for example, that would add to your basis.
Got it.
Improvements.
And I
Okay.
think
So if you paid 500,000, you spent 100,000 on a garage. Now your basis is 600,000.
Yes.
Before they start counting up to the 250 or the 500.
Okay.
it's a super important discussion for people that, are looking to start to downsize. Because you think if they purchased their home and they purchased it 30, 40 years ago for $40,000, $50,000, and now here in central Massachusetts, some of our sales prices are $750,000, $800,000, $900,000. They need to make sure they have the right financial team and tax team in place, because that could come into play.
Exactly.
Does that offset the mutual funds and all that in their whole portfolio? That doesn't offset anything. We're just talking real estate, that's 250 and 500, right? So you can't look at the whole portfolio and say, well, you got these and this. It's
No,
real
you
estate.
wouldn't be able to offset that with losses, say, in the stock market.
Right.
Yeah.
If they purchased it, let's say for $40,000, okay, if they've refinanced it over the years, and let's say now they're mortgaged to like $300,000, but we could sell it for $750,000. Does it all go back to the $40,000 they bought it for?
Yes.
Yeah.
Wow.
So that's super important.
Let me clarify on that last thing I said. If you had $200,000 capital gain on real estate, but you had losses in your stock portfolio when you do your taxes, they would offset.
Got it.
But So that's a correction. Yeah.
So that, but
yeah.
it doesn't come into play when you're figuring out when you're just selling. But to your point is, what do you mean it goes back to the 40,000? Even if they refinanced and there's
Has nothing to do with financing. It's what they paid plus improvements. And you subtract that from what they sell it for. So your basis is what you paid for the property plus improvements. And the basis is how they count taxes. So if your basis is $500,000 and you sell it for $750,000, it's a $250,000 gain. If you bought the house for $40,000 and did nothing to it, then your basis is $40,000. It doesn't matter if you've refinanced or financing has
Even
nothing,
if you
not part of
take
the
on more
equation.
debt,
Yeah.
it has nothing to do with that cost basis.
really interesting.
Amount.
It is, and it's something I think that most real estate agents, thank goodness we have that disclosure that it's like, we are not tax advisors. But more and more agents need to understand that, because it does impact the affordability of where the people are going next.
Sure.
When we think about retirement communities and how expensive those assisted living facilities or even, healthy living facilities are, it's really important, I think, to think about that when you're downsizing a home that you bought maybe 30 or 40 years ago.
I think a lot of people just think about what we've been seeing most recently is they're not holding on to their properties long. My parents, I still have their
Stayed
property,
forever.
right? So, and I've moved so many times, right? So, I think people that are short term, they get nervous about the taxes. But I think if you're there 2 years, right, you'd have to have a certain time period that you
Longer
have to
than a
be-
year.
right? But think about that versus the people that have been there for the 30 plus years. right?
Yeah.
So I never think of that. I always think that the people that have had their property for so long, they don't have to worry about a tax consequence,
Because it's been their primary residence.
right?
But there's so many different factors to it.
Yeah.
And I think as we talk about affordability, especially here in central Massachusetts, that's where that other question that the other person wrote in about is it okay to dip into your retirement to help offset the cost of your living situation now? And how do you all feel about that?
Oof. If you're not retired, it's not a good idea.
Okay.
I mean, it's going to mean you have to work longer or reduce your expectations of lifestyle in retirement or spend less in retirement if you take money out of your retirement assets, unless you're, if you've got a ton of retirement assets, it wouldn't matter. And there's also taxes. When you talk about the taxes for premature distributions and the penalties.
Yep. So if you're under 59 and a half, you typically would get a 10% IRS penalty on the distribution amount that you take out. There are some exceptions to that for a home purchase. However, it's still not recommended to do. In the case of other retirement accounts like a 401k, you can do a 401k loan if your plan allows it, in which case typically you can take up to $50,000 or however much you have in there.
50%.
50% of your 401k balance up to 50,
Sorry,
is that right?
50%.
Up to 50,000, correct, yeah.
There's so many different.
Hold on,
rules
we
to
just
remember.
hit
Yeah.
like two big topics there.
Yeah.
Okay, so first and foremost, the question about repeat your question.
Yeah. So we have clients that come to us all the time, and with the prices have increased so much over the last 36, 48 months, affordability is a factor. How do I come up with money for the down payment? Liquidity is an issue.
Yeah, down payment's a different story. I thought you were talking about living expenses.
No, purchasing,
Yeah,
just
okay,
to even get to the purchase point.
Yeah. So for a down payment, there are provisions for IRAs and Roth IRAs.
Yep.
You can take up to 10,000.
10,000. You can take 10,000 out.
Of a Roth or a Roth
It's a
or
little
a
different.
traditional.
Yep.
Yeah.
But-
401k plan at work, you can borrow money. You can borrow against that. Like she said, like Jen said, up to 50% of your value.
Or 50,000,
or
whichever is
50,000.
less.
The risk of that is if you separate from that company, separate from service, then that any remaining balance on the loan would become a taxable distribution. So you'd have to pay it off to avoid taxes and penalties or pay taxes and penalties.
Yep.
Yeah.
And they usually only give you 60 to 90 days to do that. So that can be a
we-
lump sum.
I think that has come up more in the last 3 years than probably any other question.
100%.
Especially for people that need to sell and buy at the same time.
Yep.
And their liquidity is tied up in the sale of their
Right.
home, or they might want to try to buy before they can sell.
Yep.
And liquidity, I just find in central Massachusetts is such an issue.
Yeah.
that's a good
So the IRS allows you to take up to 10,000 out of a traditional Roth IRA. You can take an IRA distribution, and if you pay it back within 60
days.
60 days,
Yep.
there's no taxes or penalties. So if you need liquidity for a short period of time, but it's risky. If you don't get the money back in within the 60 days,
Yeah.
you're going to get hit
It
with
doesn't close on time. Yeah.
It would become a new.
Dear Lord, I thought your money is your money. And you do what you want to do with it. Like, no, seriously, think about it.
Uncle Sam's your partner.
Yeah.
Isn't that always the case? So that is really interesting because I know a lot of even first home buyers. Now we're talking they're 30 and 40-year-olds. We're not talking 20s, and they have been working and they have 401ks or they have some type of
Retirement assets.
financial assets. They are dipping in. I hear it more and more. Oh, I'm just going to pull from my 401k. I'm just going to pull from my 401k. I have this young couple that just bought new construction. I'm pulling it from my 401k. Is this a norm? Or is this something that you're saying, let's look at it another way, like save your money instead? Like, give me the pros, cons.
Yeah, definitely. And just to clarify, the 10,000 exclusion is only available for first-time home buyers.
Oh.
So if you're purchasing a second home, then it's going to be the 10% penalty potentially on a traditional IRA. So for investors taking money out of their retirement accounts, we're not really seeing it too much. We are seeing a lot of clients moving around, whether it's moving back up north from Florida or just across the state. there's a lot of that happening, but we're not seeing too much of at least our clients that are dipping into their retirement assets. And I can understand, for the younger generations, them, feeling the need to tap into, any source of assets that they've accumulated. It can be, a very delicate situation depending on their personal situation. If they can wait a little bit, it might be better given the current the current environment that we're in with interest rates, two,
And
the
with the stock
prices,
market.
and with the stock market,
Yeah.
right? If you're needing to pull money out now during the volatility, that might set you back a little bit more than it would have 8 months ago. So.
On a Roth IRA, if you've had it for at least 5 years, you can take out the basis,
The money you put in.
the money you put in, without any taxes or penalties.
Oh.
So if you've put in $200,000 in your Roth over the last 5 years, and the earnings say might be a couple $100,000, you could take that $200,000 out. That's the basis without any issues.
Without any penalties.
Correct, yeah.
No taxes or penalties because it's after-tax money.
your own
That's
money.
funded.
It is your money.
And
That is
apply,
your money, yeah.
and apply it
Yeah.
to anything.
Sure, yeah.
Yeah.
Okay.
But I hear what you're saying about people wanting to use their homes as piggy banks all the time. And thank goodness you're not seeing it a ton with their retirement accounts. But it really comes down to affordability and living within your means. Because you want that equity in your home for problems that come up down the road.
Yeah, it's especially tough with rent increasing too. They don't really have a choice on whether they pay a lot of money for their mortgage payments or they pay a lot of money for rent. But typically we wouldn't say, hey, let's not draw it from your retirement unless there's no other options, in which case, you have to look at if you can live where you are longer, if you can afford that rent. Can you get a part-time job in addition to your full-time, right? I know a lot of people are doing that. Unfortunately, they feel
You're
like they have to.
seeing that a lot.
Yeah. Yeah,
Wow.
absolutely.
I didn't actually, I hear more and more people are not working than are finding a second job. It really does blow my mind.
Yeah, it's hard out there with inflation rates being as they were in the last few years. It's tough.
Super scary.
We went through a period of time in the younger first home buyers having not anything in a savings account several years back. People were coming, trying to buy a property, say, well, I have great credit, I have no money. I'm like, well, I don't know how you're going to buy a house.
Right.
Because it's not just down payment, it's our closing costs. And then now you have to pay for utilities.
Yeah.
And then you're going to have small furnishings. You don't have to fill it. But, there's a lot of insurance. There's a lot of things.
Repairs,
taxes, and everything.
maintenance,
Right.
yeah.
The repairs
So-
and maintenance, definitely.
Right. So it really amazes me that there's consumers that are actually saving and they have the money, but it still blows my mind that they are pulling money out of a 401k or something to purchase. Still.
Yeah, with the 401k, you do have the advantage of borrowing from it versus taking a distribution, which allows you to pay interest to yourself.
Okay.
Versus taking it from a bank, right? But there are, disadvantages to that too. As Kerry mentioned, if you separate from service, you only have maybe 90 days to
The other
pay it
thing
back.
is, if you do take a loan from a 401k, you're actually redeeming those assets that you hold in the 401k to fund the loan. And a lot of 401k administrators will charge an interest rate, which is really meant to pay yourself back to make up for the difference in returns, hopefully. But so that's a disadvantage as well, because now you're untied to the market and you're having to make up your potential returns that you could have earned with your own money. So that's another
So
big
if you borrow
disadvantage.
$100,000 from your or $50,000 from your 401k, that $50,000 no longer invested in the stock market. It's set aside and you pay yourself interest.
Yeah.
Right.
4% interest.
Yeah.
So that's a disadvantage. But getting back to people saving for a down payment.
Yeah.
I mean, you can ask for a raise. In your case, you can just sell more houses. Or sometimes we recommend you get rid of a child. It can be really difficult. But I also see the other end of the spectrum. You've got a family that's earning a couple $100,000 a year, and they don't have a lot of savings.
Yep.
And then you make a plan, and a year later they're earning $300,000 a year, and they still claim they can't afford to save any money.
Yeah, we
So
call
a lot
that-
of it's discipline. Paying attention to what's discretionary and what you really need to spend, and putting the money away before your mind finds a way to spend it. So I tell clients is. Listen, if the money's sitting in your checking account, you might need a new car. If it's put away, you're going to say, well, I'm going to stay with the car I have, or whatever the discretionary decision you're going to make.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Axiom Wealth Partners are not affiliated.
You brought up a point about the investors. And I think there's been, in my world, a lot more 1031 exchanges going on.
Yeah.
So my clients are taking their investment properties, putting them on the market all together, and then finding a second home or a vacation home or the home so now they can go be next to their grandchildren, using that as a 1031 exchange.
There are a few requirements, like you have to consider it a like kind
Correct.
property, so you wouldn't be able to use it as a residence. It would need to be an investment property or business
or
property.
rental type thing.
Yep, as long as you're receiving rental income, you can take advantage of that.
Property.
Yeah. It does need to be greater or equal value as well, so you can't sell your home, your investment property for only $300,000 and then purchase another one for $250,000. That extra amount is going to be considered taxable.
Can you take the combined? Let's use this as an example. It's $500,000, and you're buying $1 million home.
Ask
Yes.
a CPA.
Yeah.
Right.
I'm not,
Yeah.
I'm not I'm not sure
The
what
cost
to answer that one,
basis,
yeah.
the cost
Yeah.
basis can be considered.
But I
through a
understand that going
1031
below,
exchange,
like you
yeah.
don't, and then you're pocketing the difference. Like, I
Yeah,
get it. I get it. The
exactly.
1031
Yeah.
exchange is from like to like.
Yeah.
But that's pretty interesting too, because there are some people that I wouldn't be calling them investors, so to speak,
Right.
but that's part of their portfolio. They have a retirement fund, they have their, retirement accounts, and then they have investment property that it's amazing, they've had their property for 30 plus years, and you don't think they have multifamilies or a garage that they're renting out or whatnot. And then they say, yeah, well, now we're going to move. We want to get closer to the grandchildren.
Yeah.
So now we're going to sell that. So they're not taking money out of their financial, but they are going into it like a 1031 exchange.
Yeah.
Yes, they're not going to move right away. So it becomes like, I'm going to use a lack of words, Airbnb
They
or
have
rental
to
type
use
thing.
it as an income property for a certain amount of time,
Correct.
and then they can move into it.
Yeah,
okay.
they only have a certain period as
Yeah.
well to do that, so they
Yes,
can't
that 45-day
hold
window.
on
or
to
type
that.
Of,
Yeah.
Right. Yeah, so it's fast paced, and that's why you need a really good real estate agent and
Yeah.
really good attorney, because they will
Complicated,
keep
yeah.
that in place.
But having real estate as part of your portfolio is a great idea.
That was one of the questions I was just going to have.
Yeah.
Like, do you feel that that's one of the most secure investments people can make long term?
It's a complicated question.
yeah, it's complicated.
Why?
Because I would say that it is.
I do too.
I wouldn't say that because, if you have a portfolio of properties in different areas, I could say yes.
More
Because
diversified,
over time, I mean, the historic appreciation of real estate, don't quote me, but I think since 1920 is 3%. Basically keeps up with inflation.
Yeah.
And so you're likely to get that. But there are risks, if you have a neighborhood that goes downhill,
Natural
disasters,
yeah.
you read my mind. So having one property in one location can have risks. Having a portfolio of properties is a little bit safer, and a lot of times investors pool in together to buy a portfolio of properties.
Oh, we're seeing that more and more and
Yeah.
more.
Huge.
And it's,
Yeah.
for people like us that care about our communities, it is somewhat terrifying. To me, it really, really is.
Yeah.
Because it challenges the affordability for the average person to be able to buy a home.
That's a good
yeah,
point.
yeah. I've read something about that. Yeah, where private equity groups are buying real estate and driving prices up even higher. Yeah. So.
But you would recommend individuals, couples to incorporate in your portfolio real estate?
It might be suitable for them.
It might be suitable. Yeah, good answer. Not for everyone.
Yeah.
Some people can't afford to do that.
Well, think about the rental. I mean, if
but-
they're renting an apartment over and over and they're just throwing it.
Oh, having a primary residence is very, very important because that is a vehicle that will help you grow your wealth over time. I mean, for some people, they choose. They may be wealthy and be well able to afford a primary residence, but just choose not to because of lifestyle and maybe they travel a lot and have to move a lot and they don't want to.
Yeah.
But for most people, I think it's a key piece of their long-term,
Success,
state,
yeah.
Talk to me about trusts. Real estate trusts. Like, talk to me about why someone would need to do that, want to do that, should do that.
Don't trust anybody.
No, there's no trusting, especially financial. Just joking.
So for having your primary residence in a trust, I mean, it's usually a great idea. It would help protect your home and your assets from being disqualified from services like Medicaid.
Yeah, just to clarify, if you need long-term care, if you're elderly and you need long-term care, your home could disqualify you, the value of your home,
Going through that right now. with 3 clients.
or a second home. So having the home in a trust will help you qualify, or home, your cash assets will help you, and also it protects you from lawsuits. Bankruptcy, you never know what can happen in your life. Maybe you have a heart attack and you've got a high overhead and you can't pay your bills. And if your home is in a trust, at least that's safe from creditors and lawsuits.
Because they can't come after you personally, even though you are an owner or you're a trustee.
Yeah, you don't own the property if it's in a trust.
They can't come after you for that trust or for that home. Yep. So that home is protected as an asset.
There's details, but and we're not lawyers.
Right.
But in a general sense, if a property's in a trust, the trust owns it, and then the trustees manage it on behalf of the grantor, the person that gives the house to the trust.
Yeah, the key point is that it needs to be an irrevocable trust. So essentially, you as the owner of the home, you would not be able to take action to change the trust in any way. So that's why you're able to separate that from it being an asset for creditors or to be considered within
There's
how
the
much
key.
income you have or what your assets are for long-term care.
Yep. You said this was coming up with your clients.
Oh yeah, this is something I think that's coming up more and more with people that are in their 60s, 70s, 80s that own homes. And I'm saying to all of my clients, go and talk to your attorney, make sure that you have things in order so that if you have to go to a nursing home for any sort of long-term care, if there's an accident, if there's a fall, if there's a heart attack or something else, your family isn't worried about being displaced. Or what you've saved for your whole life
Is going to be taken away.
is getting taken away from you. And really that 5-year window is key.
Yes.
And people don't realize how old they are anymore. I mean, I don't realize how old I am. You know what I mean? So I just think it's important for people to understand that just like when we had the insurance agent on, there are things that you have to put in place to keep your primary residence and your investment safe.
Yeah, it's good advice. We always recommend that clients, if they don't have an estate plan, that they talk to an attorney to find out what they need.
Because people want to talk about it when it's too late.
Right.
Right.
You know,
You
Dad's
can't
in
go
the
back in
hospital.
5 years,
Yeah,
right?
you can't. And they are so critical about those things. You know,
What is the just having basic questions for retirement? What is a start for people when they reach out to you? They don't know what to do for finance. They bought a house, now they got to start saving. They how do I put money into a retirement? Like what do you recommend? I know you take approach by individuals, but where would you recommend people?
The best starting point, just speaking in general terms, is just making sure you have enough cash assets to cover at least 3 to 6 months expenses. I'm sure you're all tired of hearing that, but 3 to 6 months at a minimum. And then saving, once you have all your debt paid out, you should realistically make sure that you don't have any credit card debt that's accumulating, and make sure you're paying off your credit cards monthly if you can. And if you can't, making sure that you're paying a lot more or more than what that minimum balance is towards the highest balance credit card. Take that first highest balance credit card down and then apply it, go to the next one if you have more than one, hopefully not, but that's the second step. And then, once your debt is paid off, or another option, I should say, is balance transfers. A lot of credit card companies are offering 0% interest for credit balance transfers for a period of time, whether that's 6 months, a year, 24 months. That is a good way to keep your money instead of paying the credit card companies if you can't manage to pay down that debt. And for some, that might not be an option depending on what their credit score is. Or if they don't qualify. Otherwise, you'll just want to make sure that you attack that first highest balance credit card first. Once you're clear of those, the highest interest rate, you got it. Once you're free and clear of the the debt, then you're going to want to start to save. And generally, you're going to want to save, if you can, 15 to 20% of your income, and maxing out your 401k match if you have a 401k. If you're self-employed, there's other retirement plan vehicles that you can open, like a SEP IRA if you're self-employed, or an individual 401k. So you'll want to try and save as much as you can, but typically we'll say, between 15 to 20%.
Towards your retirement.
Towards your retirement, yeah.
So for our listeners out there who have children, and if you have 15, 16, 17, 18, 19, 20, 21-year-olds that are still living at home, my recommendation is to take David's advice and take 20% of your kid's paycheck every single week and put it away for them. Get them to learn to live without that money now, and then you can give it back to them as a down payment for a house.
Good move.
Yeah. And there's a lot of other investment vehicles that you can utilize for children specifically,
Right.
To save those extra, or I shouldn't say extra, that 20%, save that 20% for the child through different vehicles, like a UTMA account, for example.
Yeah.
When we look at that minimum wage in Massachusetts, it is so high. And so for those people entering the workforce at a young age, it is so easy for them not to understand the cost of living. And if they get used to spending $400 a week going out and eating, and then all of a sudden want to move out of mom and dad's house and don't understand how high the rent is, it's really, we talk about financial literacy, and it's so important for them to understand those concepts.
Think about the mortgage payments that changed.
Yeah.
People were thinking that their mortgage payment was going to be low and lower than their rental right now.
Yeah.
Well, just try to go buy a median price house in North Central, a median price. And I don't know how I could go to bed at night with that kind of price. They're only putting maybe 5 or 10% down, maybe only 3.5% down. And their monthly mortgage payment, how do they go to dinner? How do they do that? Well, I think that's really, really important, because I think the saving part is hard for them. They'll say, I can pay, I can go for retirement later. I can do all my retirement later. My company is doing a 401k. I'm all set. I got my retirement.
Yeah.
That's not going to be enough.
No.
And then you find people having to work until they're 80 years old before they can retire. So
I think
tough.
getting that first home is important, and it makes sense to make some sacrifices. And if you have to delay retirement savings for a while, it's probably worthwhile to buy that home, because it's going to be an asset that you have or can sell
And
switch
security.
homes. And typically people's income grows over time, particularly for young people. And so they'll grow into the, you don't want, and you guys keep people from biting off more than they can chew, right?
Yeah.
You give them advice
Sure.
about how much of their income they should spend on a home. But I think it's a good move for them to make those sacrifices and forget, going out to dinner and trips and, pay that mortgage for a while. And, eventually they'll make more money and be able to do a little better.
Yeah, what you were describing too is the lifestyle inflation, right? You get a raise and then you immediately want to use that additional money to pay for a new subscription or
Great
a new
point, Jen.
phone or a new
Trip
car.
to Key West.
Right. But you might not think about, the cost to order a pizza is still going to go up. Groceries, eggs, milk, right? So those costs are going to go up typically 3% on average over the course of 10 years. That's been roughly the average of inflation for everyday costs of living. But you definitely want to consider saving the additional amount that you're getting as a raise. We typically do like a 50, 30, 20 rule. So you use 50% of your income to buy needs, food, rent, and then 30% for wants, maybe eating out. 20% would be to save or invest or pay off debt.
That's a good rule.
Another compromise that especially the younger generations are making even today is multi-generational homes where they're
Yes.
staying with mom and
So
dad
many.
a lot longer. I looked at a study, it was about 20% as of 2 years ago. So it's, something that helps them save more so they can be better prepared when they're making that first purchase as well.
Definitely seeing that shift more and more. I mean, I can't even find houses now. More and more people are saying, well, mom and dad are going to sell their house. They're going to take that chunk of net proceeds. They're going to put it into the new house, and everyone's going to live happily ever after, in, like your home, happily ever after in the house. And then we're all going to be back to this. And thank goodness for mom and dad who, can give that down payment down. But I still think that, it's lifestyle, right?
Yeah.
And so it's constantly changing. Interesting though, because I always find, I wonder when they're going to start saving. When do they start doing that? The literacy of the whole financial world. It's like, when did they stop teaching it? I mean, I don't
Right.
know.
But I actually think that the generation of kids now are much more financially savvy than we were ever taught to be.
That's good to hear.
I mean, I've got 4 kids in their 20s, and my 23-year-old has really, really strong investments, which shocks me. But the other 2, even though their portfolios haven't really started yet, they're so smart about their money. And I see it with the majority of their friends too. I mean, I had a 26-year-old that just bought an $800,000 house, and his mom's sitting there saying to me, Sarah, you can't sell him that house. Sarah, don't sell him that house. Sarah, I said he can't afford that house. But she didn't see what he has. You know what I mean?
Right.
And his lender was like, no, he can afford the $6,000 a month mortgage. And I'm sitting there going like, oh, no, thank you.
That's what I'm talking about. It's most nauseating. But
Yeah.
the other thing is, I want to get into their brains. Like, how are they thinking? Because when I was buying, 20% down, regardless. And you better have some savings because it's going to be a rainy day one day.
Yeah.
And that's how when I bought my first house, that's what it was like. Right now, how are they thinking? Like, are they calling financial people? Are they,
What's the average age of your client?
yeah.
Most of our clients are 50 and up.
Well, we're the majority out there, right?
Yeah. I do get children of my clients sometimes, look for help and advice, but they don't have an asset. I mean, we're looking for clients that have at least $500,000 in investable assets. We do make exceptions, but that's generally, for investment services. For financial planning, we charge a flat rate, so anybody can do that, and that's a great help for younger people. It's sort of like, if you have a personal trainer, and they're going to meet you at the gym every week, you're more likely to show up and get results. And so it's sort of the same thing. We say, okay, here's the plan. We're going to meet again, and we're going to, see how you did. And so people tend to get better results if they have that kind of coaching.
Good.
So, we do that typically do that for, and then young people often have insurance needs, particularly if they're young and they have young children. I find they're often underinsured. They might have a policy through work. Sometimes they can increase that policy and get the coverage they need. But, typically, if you got a 30-year-old with a young child and they're going to work another 35 years and they make $100,000 a year, well, that's $350,000. Is that right? 100,000 times 35. Yeah.
Yeah.
$3.5 million. And so, if they want to insure that call it a lifetime value, they would need $3.5 million of coverage. Or they may just want to have enough insurance. It depends on their situation and how much money they have. But often they're terribly underinsured, and if they died, then their spouse would have to downsize or move into a, they don't want to leave their house and their friends.
Especially
so you don't want to, it's a low risk situation, but it's disastrous, and you want to make sure you have the coverage you need to meet your expectations at least, for surviving.
Speaking of the human. The two methods in determining what insurance coverage you should have is the human life value and then the needs analysis. Did I have that right? Those two are the insurance.
Sure. Yeah. Exactly. Yeah.
So the human life value, that's projecting what that income amount is in the future. So
So you might want to take into consideration raises and promotions, or maybe not, but. What your expected earnings are for the rest of your life is one way to look at it, and then needs would be what's the minimum I can manage with. So if you're on a tight budget, you would probably go with a needs approach, and if you have a healthy income, you might want to insure yourself for your human life value. Which is terrible.
So much
terrible
to
phrase
think
as far
about.
as I'm concerned.
So much.
Yeah.
So much.
I feel like a lot of people my generation or younger tend to push that off, right? They don't want to think, I'm going to die accidentally. So that can be a huge risk, especially if you have younger children.
That makes so much sense. I think you all have opened our eyes to so many different things that our, people in our sphere, our listeners, our clients really need to have awareness on. So thank you.
Absolutely.
Yeah.
So how do they reach you? I know we're going to show that at the end of this, but maybe you can just, when people are listening, how do they go about reaching out to you?
Oh, yes, definitely. So if you're interested in, evaluating your personal situation, you can, whether that's financial planning or reviewing your portfolio for optimization, you can visit us at axiomwealthpartners.com. You'll find our phone numbers on there, and just give us a call or drop us an email. And
Thank you.
Thank you so much. It was so great having you all. Yes.
It was.
And you can find me, Lana, at Coldwell Banker in Leominster. Please subscribe. Please send us questions. I'm happy to get guests on here that can answer them. And Sarah, thanks for joining me.
Yes,
Please tell everybody where they can find you.
So you can find me with the hometown team at Real Broker, serving the North Quabbin region of Massachusetts. And thanks so much for allowing me to be your co-host.
Excellent. Thanks. Thank you, guys.
thank you.
Thank you.